above that. So in that area where you have this harmonic synchronicity is where you get this type of market activity. And this is why these are the key areas that are going to cause this type of activity and that sort of harmonic resonance. There's one more key principle I'm going to go over in this video, and that is what happens around the dough levels when we're moving between octaves. What happens around the dough and the level above the dough in an upward ascending octave is the re tone, and a descending octave it is the T tone. As we go do re mi and backwards we go do ti la. So the T and the re are significant, and we can use those to indicate whether we're going to ascend. We can look to that as potential shock points to tell us if we're going to ascend and move up into another octave, or if we're going to descend and if we're going to continue down and start to trade into that lower octave. So let me recalc the charts and we'll take a look at that. Okay, on the chart now you can see our 3 octave boxes. I've rolled it back to 71. I put the dough tones in blue with blue horizontal lines. So we've got the first octave starting here. Here's the dough tone where the first octave ends and the second octave begins. Here's the end of the second octave and the beginning of the third octave with the dough tone. And then when I've done, I've marked the re note and the T note in orange. So from the third octave, here's the re note, the 12.5%, and here's the T note in the octave below, the 87.5%. And from the first octave to the second octave, you have the re note above and the T note below. So what happens when we're looking to change and move into a higher octave? The dough tone is one of the places where we need a shock to be able to push higher and get into that second zone and stay there. So one of the key concepts from the Gurdjieff writings, the Tales of Beelzebub, is in order to achieve enough shock to get into an ascending octave to move into the higher octave, we have to be able to get beyond the re note. If we can't get beyond the re note, we're probably going to drop back and continue to trade in the octave below. The same principle applies on a descending octave. If we can't trade down and breach the T note and get below that, then we're going to probably stay in the higher octave. So let's take a look at the chart with those principles in mind and see what happens. So when we're looking to trade up to break into our third octave from the second octave, we have to actually get above the re note and get a good close above there to stay into that octave. So you can see that each one of these breaches above the re note, the first one here in 77, this one here in 88, we didn't get beyond the dough in 97. It looked like we might have made it in 2004, but that was probably the end of the cycle in the and then we finally get beyond that re note here in 2007, where we get this solid close in November, and from that point on we stay there. So what happens then, we have this bull market, then we turn into this bearish mode, we get back to the octave, and we do break the octave, so we have the potential to come back and trade into the lower octave. But what happens, we get to the T note, we break the T note, but we do not get a close below the T note, and that prevents us from moving into that lower octave. The same thing happens here in 2015. You can see we trade for months above the T note, hanging around the dough gravity center and we don't breach. Same thing in 18, 19, and 20. We come down, get to the T note, we crack it for months here, we crack it for 1 month here, we spike down, but then we immediately spike up and close above it. And then the last attempt at that is in April here of 2020. We're there for 4 months, we breach it, but we do not get a close below that level. And then what happens? We finally take off and get into that mega run in 2020. Now looking at that the other way in the lower octave, let's take a look at that. So we get a breach here on the lower level. We make a move up, we get up above the ray tone, but we don't get a close. That's indicating that we're probably going to drop back down. So what happens? We do trade down that same month. We get a close below the ray note, and then for another month we're there. But then finally in April 73, we get a close above both levels, and that's kicking us back into the dough higher octave. So what happens? We got a 2 month close below. It looked like we were going to drop back, but we're in the middle of that bull market. As soon as we get a close, this is an important concept with this, we are getting a close 2 tonal levels above. So we're getting a close. We had the close below the T-tone in March. In April, we close above 2 tones. We close above the T and the dough. When we get a 2-tone close above, that's a strong indication that we're going to kick back and remain in that higher octave, which happens. Then what happens? We get into this bear market. We test and get support at the dough tone. We don't even challenge the ray tone. Again here, when we come into 1986, we're pushing close to the dough tone. We do not challenge the T-tone, not the ray there. And then again, we come into now we go 12, 13 years later, 1999. We're hanging on the dough level here. We get one close below dough. We break the T level, but we do not get a close below T. What is that telling us? That it's telling us we're going to stay above the dough tone. Unless we are going to break this T level, we are going to stay above dough. Here we get a close below the dough, but the T is strong support. And then we get challenged one more time in 2001, 2002. What happens? The T level holds support for 6 months, and then we finally move out and regain that second octave. So that's a key concept when working with octaves. If you have the correct octave, if you have the correct dominant octave like the 7 is on the soybean chart, this is going to tell you what's going to most likely happen when you get around these key levels. So those are the primary concepts of importance for reading these levels and identifying what's most likely to with the price action as you get at these points. So when using this sort of thinking in tandem with